an Intelligent Investor by Benjamin Graham. Key takeaways. Number 1. Invest with a margin of safety to protect against losses. The purpose of the margin of safety is to render the forecast unnecessary. Safety first. The margin of safety is the cornerstone of Graham's investment philosophy. It involves buying securities at a significant discount to their intrinsic value, providing a buffer against potential losses. This approach helps protect investors from poor business performance, market volatility, and analytical errors. Practical application. Look for stocks trading below their net current asset value. Seek bonds selling at a discount to par value. Focus on companies with low debt-to-equity ratios. Prefer stocks with price-to-earnings ratios below the market average. By consistently applying the margin of safety principle, investors can minimize downside risk while positioning themselves for potential upside. Number 2. Distinguish between investing and speculation. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Define your approach. Graham emphasizes the importance of clearly differentiating between investing and speculation. Investing involves thorough analysis, a focus on preserving capital and seeking reasonable returns. Speculation, on the other hand, relies on market timing, short-term price movements, and often disregards fundamental value. Key distinctions. Investors focus on long-term business performance, speculators on short-term price movements. Investors seek safety of principal, speculators accept higher risk for potentially higher returns. Investors analyze financial statements, speculators often rely on market trends or rumors. By understanding this distinction, investors can avoid common pitfalls and maintain a disciplined approach to building wealth over time. Number 3. Focus on business fundamentals, not market fluctuations. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Long-term perspective. Graham argues that investors should concentrate on the underlying business fundamentals rather than short-term market movements. While market prices can be irrational in the short term, they eventually reflect the true value of a company's business over time. Key fundamentals to analyze: earnings history and stability, dividend record, balance sheet strength, competitive position in the industry, management quality and integrity. By focusing on these factors, investors can make informed decisions based on a company's intrinsic value rather than being swayed by market sentiment or temporary price fluctuations. Number 4. Diversify your portfolio to manage risk. The only way to deal with risk is to spread it around. Spread your bets. Diversification is a crucial risk management strategy for investors. By spreading investments across different asset classes, industries, and geographic regions, investors can reduce the impact of poor performance in any single investment on their overall portfolio. Diversification strategies: invest in a mix of stocks, bonds, and cash. Include both growth and value stocks. Consider international markets. Allocate across various sectors and industries. Include both large-cap and small-cap stocks. While diversification doesn't guarantee profits or protect against losses, it helps mitigate risk and can lead to more consistent long-term returns. Number 5. Understand the difference between price and value. Price is what you pay. Value is what you get. Value over price. Graham emphasizes that investors should focus on the intrinsic value of a security rather than its market price. Price is simply what the market is currently willing to pay, while value represents the actual worth of the underlying business. Determining value: analyze financial statements, assess the company's competitive position, consider future growth prospects, evaluate management quality, factor in industry trends and economic conditions. By understanding this distinction, investors can identify opportunities where market prices diverge significantly from intrinsic value, potentially leading to profitable investments. Number 6. Be wary of overhyped growth stocks and new issues. The more enthusiastic investors become about the stock market in the long run, the more certain they are to be proved wrong in the short run. Skepticism pays. Graham cautions investors against getting caught up in market hype, particularly around high-growth stocks and initial public offerings, IPOs. These investments often come with inflated valuations and unrealistic expectations, leading to potential disappointment and losses. Red flags to watch for: extremely high price-to-earnings ratios, rapid revenue growth without corresponding profit growth, overly optimistic projections from management or analysts, lack of a clear competitive advantage, heavy insider selling. By maintaining a skeptical approach and focusing on fundamentals, investors can avoid costly mistakes and protect their capital from speculative bubbles. Number 7. Practice disciplined, unemotional investing. The investor's chief problem, and even his worst enemy, is likely to be himself. Control your emotions. Graham emphasizes the importance of maintaining a disciplined, unemotional approach to investing. Many investors fall prey to fear and greed, leading to poor decision-making and suboptimal returns. Strategies for emotional control: develop a clear investment plan and stick to it. Avoid making impulsive decisions based on short-term market movements. Regularly rebalance your portfolio to maintain your target asset allocation. Consider dollar-cost averaging to remove timing decisions. Keep a long-term perspective and avoid obsessing over daily price fluctuations. By mastering their emotions and maintaining discipline, investors can avoid common behavioral pitfalls and improve their long-term results. Number 8. View market fluctuations as opportunities, not threats. The intelligent investor is a realist who sells to optimists and buys from pessimists. Embrace volatility. Graham encourages investors to view market fluctuations as opportunities rather than threats. Instead of fearing market declines, intelligent investors use them to buy quality assets at discounted prices. Capitalizing on market fluctuations, maintain a watch list of quality companies to buy during market downturns. Set target prices for buying and selling based on intrinsic value estimates. Use market dips to add to existing positions in strong companies. Consider selling overvalued holdings during market euphoria. Keep cash reserves available to take advantage of sudden opportunities. By adopting this mindset, investors can turn market volatility into a source of potential profit rather than anxiety. Number 9. Analyze financial statements to uncover hidden value. The secret of sound investment in 3 words: margin of safety. Do your homework. Graham emphasizes the importance of thorough financial analysis to uncover hidden value and potential risks. By carefully examining financial statements, investors can gain insights that may not be apparent from surface-level metrics or market sentiment. Key areas to analyze: balance sheet. Look for strong asset coverage and low debt levels. Income statement. Assess profitability trends and earnings quality. Cash flow statement. Evaluate the company's ability to generate and manage cash. Footnotes. Scrutinize for potential red flags or hidden liabilities. Historical performance. Analyze trends over multiple years. Through diligent analysis, investors can identify undervalued opportunities and avoid potential pitfalls that may not be immediately obvious. Number 10. Seek companies with strong, consistent financial performance. The stock investor is neither right nor wrong because others agreed or disagreed with him. He is right because his facts and analysis are right. Quality matters. Graham advocates focusing on companies with a proven track record of strong and consistent financial performance. These companies are more likely to weather economic downturns and provide stable returns over the long term. Characteristics of strong performers: consistent earnings growth over multiple years, stable or increasing profit margins, strong return on equity, ROE, manageable debt levels, consistent dividend payments and growth, competitive advantages in their industry. By prioritizing companies with these qualities, investors can build a portfolio of reliable, high-quality businesses that are more likely to deliver satisfactory long-term results.